grants. The other one is stock options, and then your stock appreciation rights. Now, let me first explain why we need these. Then we will talk about the differences in all three of them. See, if you've already covered the corporate issuers material, you know all about corporate governance and how it is important to align the interest of your management with your owners, right? You must have studied about the principal agent problem. And if you still haven't studied that, let me tell you a little bit about it. That your owners are your principal, right? And your management are their agents who they appoint to manage the business on their behalf. And if the management starts taking decisions which benefit the management instead of the owners, that is known as the principal agent problem. And how do we fix this is by aligning the incentives of the management with the owners. Now, the owners are obviously the shareholders, right? So if we make the management a shareholder as well, then they will try to increase the share price. Now, how do we make the management a shareholder? Well, you can just give them the shares, right? That is where your stock grants come in. Or you can give them the option to buy the shares at a certain price. Or you can give them stock appreciation rights that if the share price goes up, then the management gets money. So there are three ways of aligning the incentive of management with the owners. And we're going to look at all three of those. And what is common in all three situations is that whether you're doing IFRS or US GAAP based financial reporting, that you need to come up with a value of this compensation that you're giving to the management, this share based compensation, whether it is a grant or a stock option or a share appreciation right, it is going to have a certain fair value. And this benefit or this compensation is not given in just 1 year, it is over a number of years. So you need to take that value and divide it across a number of years. And most likely this is the type of question that you will get, that let's say if the fair value of a compensation is 100,000 and it's for 5 years, then the yearly expense recorded will be 20,000. So this is the type of question you can expect. Right. Before we get into the different types of share-based compensation, let's just talk about the disadvantages. And why this is important is because when we will talk about the different types of share-based compensation, such as stock grants, stock options, your share appreciation rights, the three that we just discussed, some of these have these disadvantages and some of these don't. So, for example, let's talk about this last disadvantage, that when shares are granted to employees, the existing shareholders' ownership is diluted. So let's say you own a company, you own 100% of a company, but then you decide to give 10% to your management, right? You decide to give 10% to your management. So now your ownership gets diluted to 90%. That would happen in the case of a stock grant, that would happen in the case of a stock option, but it would not happen in the case of a share appreciation right, because in the case of a share appreciation right, you don't give them the actual shares, you just give them compensation if the share appreciates. So this problem is not there with share appreciation rights. Then for your other two, right, which is employees have a limited influence over the share price. Now, what does that mean? Let's say you're talking about giving them a stock option. This problem is there with stock options. And what happens in a stock option is that you tell the management that, hey, the stock price is 40 right now. I'm letting you buy it at 50. So you work very hard and try to take the stock in the market to 60 so that you can buy it at 50 and sell it at 60. Now the employees can work very, very hard, but it's not necessary that they can drive the stock price up in the market. They can try and improve the profitability of a company. But can they really drive the stock price up in the market? The answer is no, because there are other factors, right? Maybe the whole market, regardless of your company or this specific company, maybe the whole market is going down. It's in a bearish trend for whatever reason. Maybe the Federal Reserve is increasing interest rates, and that's why the entire market is going down. So these employees, they will be working very hard to improve the profitability of a company, but the stock might be going down because of other reasons, and their stock option will be worthless. But if you're giving them a stock grant, then regardless of the stock price, they're just getting these shares. And even if they are going down, at least they're worth something, right? So a stock grant doesn't have this problem. And the share appreciation right doesn't have this problem. Now, managers become less risk-taking if you give them a stock option with a exercise price, with basically the right to buy that stock, which is lower than the current market price. So let's say the current market price is 40, and instead of giving them an option to buy at 50, you give them an option to buy at 30. So they can already buy and sell in the market, so why they need to bother with pushing the company's performance up? And instead of taking more risk, they actually start taking less risk. Or if you give them an option to buy at 50, which is above the market price, and they need to drive it to 60, they might become very, very risk-taking. So these stock options also have the problem that they make the management either very risk-averse or too much risk-taking. So these issues are there with share-based compensation. So it's a delicate area. It has to be planned in a very nice way, in a balanced way, so that management doesn't become too risk-taking or too risk-averse. Right, so let's get into the first type of share-based compensation, which is stock grants. And within stock grants, you have three different types. Outright grants, that you just give them the stock, no questions asked, no strings attached, right? Or you can have some conditions where either they are restricted grants, that the stock will only be given to them if they complete certain requirements, such as working for the company for minimum number of years. So minimum years they have to work. Or you can have performance based, that the earnings have to be there. And even here you can have a requirement of earnings, right? So outright grant is straightforward. You just give them the shares, and based on the value of the stock and the number of years that they are working on which this expense has to be allocated. So let's say the value is 100,000, will be given over a year, 5-year period. Then obviously every year you're going to be recording a 20,000 expense. For a restricted grant, here certain conditions have to be met, such as they work and stay with the company for a certain number of years, or there are certain performance-oriented goals that need to be met, and the accounting is the same. You take the fair value and you allocate it across the service period. For your performance shares, same situation, that it is determined by performance measures other than the change in share price. And this is really good because it addresses that issue that we were talking about, that the employee cannot really impact the share price, right? The share price is beyond their control. What they can do is maybe try and improve the accounting earnings of the company. So that is fair with them. And as far as the accounting is concerned, of course, you have to take the fair value and allocate it across the service period. Next is stock options. Right, so stock options, here you're not giving them the stock grant, you're giving them the option to buy the stock at a certain price. Now, what is that really worth? This is complicated, and you will learn about this in your derivatives study material. Especially within that, there is, right, option pricing, and that is where you're going to learn how to come up with the value for a stock option, because you're letting them buy something for 50. It's currently in the market for 40. So is this worth anything right now? I mean, think about it. Would you buy something for 50 when it's available in the market for 40? Of course not. But is this option worthless as well? The answer is no. It is worth something, because even if it is less than 50 today, tomorrow it could be more than 50, right? It could go to 60, in which case this option will be worth something, because you have the right to buy at 50 and sell at 60. So when we talk about the fair value of an option, it is equal to the intrinsic value and the time value. And let me not go into details, because you're going to be learning all about that in your derivative study material anyways for option pricing. But the important thing is that a fair value has to be estimated using an appropriate valuation model, and there are two. One is the Black-Scholes option pricing model, and the other one is the binomial, both of which you will be learning in your derivatives material. And then you take that fair value and then of course allocate it across the number of years. Now what you do need to know, which of course you will learn more in your derivatives, is that what are the inputs into these models, right? And these are known as the option Greeks, by the way, which you will learn in your derivatives. The option Greeks, such as your theta, rho, and delta, gamma, right? So rho is your risk-free rate. Higher risk-free rate leads to a higher value of the option. Theta is your time. So if you're giving them a right to buy at $50 for 5 years, that means they have a long time to take that stock price from 40 to above 50, right? So the longer the time period, the higher the time, the higher the value of this option. Of course, the exercise price at which they have a right to buy is important. The stock price volatility, which is by the way another Greek called vega, so that is for volatility. The higher the volatility, the higher the option value, because it's more chance that it can go above the exercise price, right? And the lower the exercise price, the higher the value, because you want the right to buy it at a low price, right? So if it will be at 30, that will be better for you, right? So you can buy at 30 and easily sell at 40. But the higher the price, let's say you're only getting the right to buy at 55, so the higher the price, the lower the value. And again, all of this will be discussed in your derivative material in detail. But let me just explain it here as well. Estimated dividend yield. So let's say there is a dividend on this stock, but you are not getting that dividend because, well, you have to wait till the stock goes up and then you will buy it, right? So until you are not buying it, until it is still between 50 and 40, you're not buying it and you're missing out on that dividend. And if it's a high dividend, then naturally the value of this option will be lower. What is the importance of dates? As far as stock options is concerned, number one is the grant date, right, at which it is granted to employees, but it's not immediately given to them. There is a vesting period, which means they have to first work through a number of years and then they can exercise that option. Then whatever is the exercise date at which they can actually exercise it, maybe the price will never go up, so some options will go unexercised, right? And if they are exercised, then definitely there is an expense, and that expense, as always, has to be allocated across the service period. Now let's look at this example, and there's a small trick here, but what I would suggest is that you pause the video, try to do it. It's fairly straightforward. That trick should be something that you should be able to pick up. I'll just give you a hint that look at the date and try to solve this, and then I will show you the solution. So hopefully you were able to calculate this, that the value first of all is 1 million options multiplied by the value, which is 0.5. So that gives you the entire expense, but it has to be divided by 4 because that's the number of years. And since we are starting halfway through the year, so we'll only take half of that for the first year. Second year it will be the full amount, third year full amount, fourth year full amount, and then the remaining half will be in the fifth year. Right. Now moving on to the other types of share-based compensation. So we already did the grants, we did the stock options. Now we come to stock appreciation rights. And this is very nice because it solves that problem of the dilution, right? Stock grants and stock options were both diluting your ownership and your earnings per share. So when you were giving your employees certain ownership, what was happening is that the existing shareholders' ownership was getting diluted. This problem is not there with your stock appreciation rights, because you're not really giving them any stock, you're just giving them the rights to make money if the stock price goes up. So it does align the interest of the employees with the shareholders, because the employees also want the stock price to go up without requiring them to hold the shares. So stock ownership is not diluted, and the potential for risk aversion is limited as well, because in the case of stock grants and stock options, we saw that employees might either become too risk taking, right, because they want the share price to go up, or they might become too risk averse because they don't want the stock price to go down. But with your share appreciation rights, at least this part is taken out, because it doesn't make a difference to the employees if the stock price goes down, because they're only going to make money if it goes up. They won't lose money if it goes down, right? But in the case of a stock grant or stock options, they don't want the share price to go down, so they become risk averse, and that is not good for the shareholders. So SAR actually takes care of, number one, the dilution problem, and number two, it takes out the risk averse issue, but it might make employees too risk taking. So that of course needs to be seen carefully. Another disadvantage of SAR is that it can be stock settled as well, but it can be cash settled as well. And what that means is, if the stock price goes up, then the employees will come and ask for money. In the case of a stock grant or in the case of a stock option, usually it's not settled till the end of the vesting period. So the cash flow, the cash outflow over there is much more delayed. It's deferred. Here, you have to pay them if the stock price goes up in the current period. And as with all the other share-based compensation, the accounting is done the same way. You calculate a fair value and you allocate it over the service period. Right. So let's now take a break here, and then we'll come back and discuss the presentation and disclosure requirements.